A shareholder or stockholder is an important person when dealing with stocks. Welcome to the Financial Market Examiner YouTube channel, where you learn about forex, crypto, and the stock market. So on this channel today, we'll reveal to you all you need to know about a shareholder in stocks. Get your writing materials as we learn. What's a shareholder? A shareholder is a person, company, or institution that owns at least one share of a company's stock or in a mutual fund. Shareholders essentially own the company, which comes with certain rights and responsibilities. These types of ownership allow them to reap the benefits of a business success. These rewards come in the form of increased valuation. These rewards come in the form of increased stock valuation or financial profit distributed as dividends. Conversely, when a company loses money, the share price invariably drops, which can cause shareholders to lose money or suffer declines in their portfolios. Most majority shareholders are companies' founders. In other more established companies, majority shareholders are frequently related to companies' founders, and in either case, those shareholders wield considerably power to influence critical operational decisions, including replacing board members and C-level executives like chief executive officer and other senior personnel when they control more than half of the voting interest. That's why many companies often avoid having majority shareholders among their ranks. Unlike the owners of sole proprietorships or partnerships, corporate shareholders are not personally liable for the company's debts and other financial obligations. So, if a company becomes insolvent, its creditors cannot target a shareholder's personal assets. There are a few things that people need to consider when it comes to being a shareholder. This includes the rights and responsibility involved with being a shareholder and the tax implications. Here's a list of shareholders' rights you need to know. The right to inspect the company's books and records, the power to sue the corporation for the misdeeds of its directors and officers, the right to vote on key corporate matters such as naming board directors and deciding whether or not to greenlight potential mergers, the entitlement to receive dividends, the right to attend annual meetings either in person or via conference calls, the right to vote on critical matters by proxy, either through mail, in ballots, or online voting platforms if they are unable to attend voting meetings in person, the right to claim a proportionate allocation of proceeds if a company liquidates its assets. Types of shareholders. Many companies issue two types of stock, common and preferred. Common stocks is more prevalent than preferred stock, and is what ordinary investors typically buy in the stock market. Generally, common stockholders enjoy voting rights, but preferred stockholders do not. Preferred stockholders have a priority claim to dividends, but furthermore, the dividends paid to preferred stockholders are generally more significant than those paid to common stockholders. What are the main types of shareholders? A major shareholder owns and controls more than 50% of a company's outstanding shares. This type of shareholder is often company's founders or their descendants. Minority shareholders hold less than 50% of the company's stock, even as little as one share. What are some of the key shareholder rights? Shareholders have the right to inspect the company's books and records, the power to sue the corporation for their misdeeds of its directors and officers, and the right to vote on critical corporate matters such as naming board directors. And in addition, they have the right to decide whether or not to greenlight potential mergers, the right to receive dividends, the right to attend annual meetings, the right to vote on crucial matters by proxy, and the right to claim a proportionate allocation of proceeds if the company liquidates its assets. What is the difference between preferred and common shareholders? The main difference between preferred and common shareholders is that the former typically have no voting rights, while the latter does. Preferred shareholders have a priority claim to income, meaning that they are paid dividends before common shareholders. Common shareholders are last in line regarding company assets, which means that they will be paid out after creditors, bondholders, and preferred shareholders. Shareholders or stockholders are the owners of a company's outstanding shares, which represent the residual portion of the corporation assets and earnings as well as a percentage of the company's voting power. Stockholders have a right to participate in the distribution of corporate assets in form of dividends if they are paid. and possibly through the sale of their holdings at a profit on the stock market. Individuals may become shareholders by buying common stocks in corporations through brokers or directly from the company if they offer a direct investment plan. In many countries, corporations may also offer employee stock options as a benefit for workers, and if a company goes bankrupt, however, common shareholders are last in line to be repaid. Preferred shareholders hold preferred stock, which often pays a high and steady dividend but comes with no voting rights. Preferred shareholders hold preferred stock, which often pay a high and steady dividends but comes with no voting rights. Preferred shares are therefore sometimes thought as a sort of debt equity hybrid security. So with this, we've come to the end of the video for today. Kindly share with us your feedback in the comment section. There are several educative videos on this channel where you learn more about the financial markets. Note that this video is not for financial advice but for educational purposes only. Kindly share, subscribe and like after watching. Thank you.